Hello everyone, just want to give you a quick video today. I've been MIA as I've been in Arizona looking for more land for another project, a land development project. It's a beautiful state and we're searching around the Sedona area for a new community. And we found some great plots of land and more to come on that in the future. But they are going to be really cool houses, stick built, 3-bedroom, 2-bath, 1,500 square feet, single stories, selling from 400 to 475. Should be a really nice product in the market that definitely needs it. So good stuff there. Quickly though, I want to talk about something that's really important, right? And you've seen the volatility in the markets, and I do not expect that to change. I think there's going to be risk of inflation. Now, when I say that, there's a great article by The Economist that was put out a few weeks ago about the kind of inflation we're going to see, right? Most economists now agree that the inflation is coming and it'll come in a short explosion and then come back down to reality. Powell has also realized this, which is why he's not raising the rates. He realizes that the inflation will not be long-lived. The bond markets have their own, their own take, which is why you're seeing the rates go up to some extent, and that's affecting some things, in terms of cost of capital. It's hitting mortgage rates a little bit, but not that much. And in general, it's freaking out the market. You're also seeing the market shift from high growth, high tech stocks to stocks that are more value oriented, that do make profits, that are also somewhat growing, right? So you are seeing a shift out of growth into value. And with that, you're seeing some sell-offs in the tech sector. Now, that means buying opportunities for you in the tech sector. At the end of the day, the roadmap of these tech companies are still the same. They're not changing. They still see hypergrowth. They still will be a loss leader for some time. And eventually they will turn a profit. Amazon used to lose money as well. And now they're making money, okay? So it's important to understand that this is a chance for you to buy more of the conviction and more of the plan that you had initially. Now, how do you do this? This is what I want to talk about. Some of you might know this concept, some of you might not. Something called dollar cost averaging, okay? So let's take, for example, that you want to invest $12,000 in the stock market over a course of a year. And let's assume you use Robinhood. And the nice thing about Robinhood is it allows you to buy fractional shares. So if you had 10 stocks and maybe you put 25, and you put, I don't know, or 1/10 of that $12,000 into, or $1,200, I guess, into the stock market, you could do it in a fractional share manner. Okay, what that means is, Amazon's more than $1,200, so you'd only buy like 1/3 of an Amazon share. The point is, at the end of the day, your allocation can be fractional, so that's good. But what I want to get at is the idea of dollar cost averaging. And dollar cost averaging is the idea, for example, let's say $12,000 a year is what you want to invest. That's $1,000 per month. Now, I do mine by week, so week to week. In that scenario, I would take $250 per week and deploy it into the market. And you might be buying at a peak, you might be buying at a low, but in general, you're going to average out to a cost that will prevent you from losing a lot or gaining a lot. So it's really a hedge to not have to worry about timing the market. Because here are some really quick stats. And over the course of a year, all the money managers that do this for a living, 12 hours a day, they have all the Bloomberg platforms, they have all the CFAs behind them, only 8% of them ever beat the market. Okay, 8%. And it's less than that to do it year over year, meaning you might have one year where you do beat the market, good for you. You're probably not even taking into account the volatility that you had to take on to beat the market, but it's very rare to beat it consistently. So my advice to you is don't try to time the market. Don't try to be the one-off hero trader to make an additional 3% on your portfolio. Do a dollar cost average approach, buy into it, into the dips, into the peaks. And when you do see a correction like we just saw in the last 2 weeks, put more capital. Maybe you have $12,000 as your target, but you have additional $5,000 laying aside to pick up these dips. There's typically a dip every year, and we just saw one, and I think it's gonna be a good opportunity to buy back into your conviction, buy back into your game plan, which is picking up the stocks at a cheap price. So that's my take. If you like what you heard, give it a thumbs up, and I'll be seeing you next week when I'm back from Arizona. Thanks, all.